Most investors look at senior living and think it's just apartments for older people, but it's not. Senior living is real estate with a business operating inside of it. And if you don't understand how the business actually generates revenue, you can't evaluate the investment properly. Today, I'm going to break down exactly how senior living facilities make money, where margins are created, and what separates average operators from the great ones. Welcome to week 5 of the Slam Playbook YouTube channel. My name is Roberto Carabetta, and I'm a senior living operator. My team acquires mid-market facilities across the Central Florida area. We focus both on resident care and investor performance. This channel is designed to give you a real understanding of senior living from an operator's perspective. It's not just theory. Now let's break this down properly. Senior living isn't just rent. In multifamily, you have a revenue, and it comes from rent. Yeah, you can add a little bit of other income on top, but it's mainly derived from rent, what you're charging your tenants. In senior living, that revenue, it's all layered. It could get confusing, but I'm here to walk you through the steps. Ask me questions later. Senior living rent is a base rent, but then there are also care levels above that. We'll get into more detail later. You have a care level, you have medication management, you have memory care premiums, you have activity packages, and you also have an upfront community fee. All of these attributed to your revenue and affect your bottom line. Residents aren't just paying for space, they're paying for support, supervision, safety, and a quality of life. That's why the revenue per unit is significantly higher than your traditional apartments. That complexity is also what makes this asset class hard to operate. We look at a model of revenue per resident. So let me talk about what really drives performance. It's a revenue per occupied unit. Every resident is assessed based on their care needs. Before they even move in, we are assessing that resident. Are they assisted living, care level 1, care level 2, care level 3? Are they memory care, care level 1, care level 2, and care level 3? Level 1 may require minimal assistance. They might be just coming in for a sense of belonging, a community feel. They may be widowed, so they want a sense of belonging. But once you get to care level 3 and 4, that requires significant daily support. And that has to come at a cost because now our staffing ratio is changing dependent on that care level. And we as operators have to manage that on a daily basis. So care level 3 may be help with feeding, minimal help with changing, medication reminder, or maybe a little bit of help in the shower or bathing. This all depends on how that resident has the ability to act for themselves. The higher the care level, the higher the revenue. This is where professional assessments matter. We also do these assessments on a quarterly basis, so their level of care can go up or down at any time. And on an operational standpoint, we charge for that increase, and we also charge for that decrease. Undercharging hurts margins. Overcharging creates dissatisfaction. If we're not charging properly and accurately, we're hurting our staff. We're hurting our margins. But if we're overcharging just to get that extra dollar, now we're creating the wrong reputation. We're hurting the residents and we're hurting our families. You have to be fair, consistent, and compassionate. Occupancy in senior living facilities matter more than you think. Senior living facilities have a higher fixed cost. We have staffing, utilities, food services, licensing, insurance. If occupancy is at 70%, those margins are tight. If occupancy rises to 90%, now your profitability changes dramatically. The industry saying is anything above 82, 85% is a cherry on top. That's what drives all of your profits. If you're running at 75, 80% for a long period of time, chances are you're not making too much money. Or your expenses are maybe too low and you are making money, but not for the long term. So any swing in about 10, 15% occupancy can transform these returns, whether up or down. If you're running a 50-bed facility and you drop by 2 or 3 residents in a short period of time, that hurts revenue, that hurts margins. But on the contrary, if you have a great marketing team, a great reputation in the community, and you're building those relationships with hospital partners, referral networks, and community relationships, and you might have a wait list, now that 2 or 3 resident drop, you can fill that up very quickly, maybe by 3, 4, even 5 residents in a short period of time. Now that drives revenue. Your occupancy increases, your revenue changes dramatically. This is an operating business, not just a property. In our underwriting, we have many line items in the expense section. And you know what the highest percentage of line item in the expenses is? Yeah, you got it. The largest expense in senior living is payroll. It's not just typically the largest expense, it is the largest expense, making up approximately 40% of all of your expenses. You have caregivers, you have nurses, you have executive directors, you have kitchen staff, you have housekeeping. All of this is bundled into your payroll. And that can creep up if you're not paying attention to it. If it's too high relative to revenue, your margins disappear. But if you're cutting payroll blindly, that destroys your quality and your reputation. Reputation is everything in this industry. The real skill is operational efficiency. It's scheduling properly, reducing agency uses, improving retention, and building that culture within your staff and within your community. You want to keep these staff. You don't want high turnover, but you also want them to push and drive forward every single day. So it's a fine balance. You have to know when to hire and when to fire. But you can't just be hiring and firing like a loose gun. You have to understand why you're doing and taking that action. It can affect all of your revenue and increase those expenses. A great facility runs effectively without compromising care. So my operating model is assisted living and memory care. Assisted living typically comes with care level 1, 2, or 3 in that category. Memory care also comes with care level 1, 2, or 3. But the base rents are a different price. For example, you can have an assisted living resident come in at $5,000 base rent and have a care level 3, an extra $500, $600 a month. You can have a memory care resident move in and they're only a care level 1 under the memory care section. And that could be $6,500, $7,000 per month. So it all depends on the increments you're increasing, whether it's assisted living or memory care, that drives that revenue and helps that revenue increase. Memory care typically produces higher revenue per resident. As previously mentioned, you have a higher per month cost or revenue stream. But it also requires higher staffing and tighter compliance. Assisted living can offer stronger margins with a proper care level assessment. So if you followed me in my previous example, assisted living with a care level 3 or 4 can generate great revenue. Memory care with a care level 1, yeah, you're running tight on per resident revenue because you still have to have that qualified staff member, but your memory care resident is at that level 1 band. So maybe your assisted living level 4 resident could be generating more income and more revenue for you. Understanding this mix inside the facility matters a lot. This is where professional, experienced, real operators are driving that revenue. Asset class within the asset class. That's how I say it. Why senior living can produce strong cash flow? Because you have higher revenue per unit, multiple revenue streams, a needs basis demand, and you have limited supply due to the high cost and the tight regulations in this industry. When operations are strong, this can produce meaningful cash flow, but it's not passive behind the scenes. Execution is everything. Us as operators, me, myself specifically, we're on top of these numbers every single day, meeting with our asset management team, meeting with our director of operations, sometimes even meeting with the executive directors at the facility level. All of these numbers are moving at a fast pace, and we have to be on top of it every single day, every week, every month, and every quarter. One little line item gets out of control, your whole revenue model can go down the drain very quickly. You have to have eyes on it every single day. What passive investors miss? Most passive investors focus only on the demographics. The demographics don't fix the problems. You have poor leadership, bad staffing culture, weak systems, undertrained teams. This is a recipe for disaster. Senior living success depends on operational excellence. This is why when you invest in senior living, you're investing in the operator more than you're investing in the building. Do your due diligence, find that experienced operator, and ask the right questions. So all of this in your mind is bouncing around. But how is value really created? The value in senior living and in the model that we use, value is created by increasing occupancy, improving revenue per resident, controlling payroll, optimizing that care assessment levels 1, 2, 3, and reducing inefficiencies. You'd be surprised of the facilities and assets that I acquire that have so many inefficient line items in their expenses. It's not just payroll. All of the line items we analyze and see where we can tweak the numbers. As income increases, your NOI, net operating income, also increases. Income increases, NOI increases. And because these are facilities based on income, valuation increases. I'm not going to get into it right now, maybe on the next segment, but your higher NOI divided by a cap rate, it's a capitalization rate, increases your valuation. So the main number you have to look at as an investor is your NOI. That increases or determines the valuation. It can also decrease valuation. But NOI alone is not the driving factor for why you should invest in senior living. NOI is the number you look at, but then you look at expenses and your revenue and income to see how we got to that net operating income. Your NOI drives valuation, but your revenue and your expenses drive NOI. Why this matters long term? That 80 plus population is growing. Families need solutions. Quality facilities will always be in demand. When you combine demographic tailwinds with strong operators, you create a durable business. And durable businesses build durable wealth. Senior living is powerful, but it's not simple. If you understand how the revenue actually works and how operations drive margins, you can evaluate the asset properly. If you want me to break down a real senior living facility and show the actual underwriting numbers step by step, comment SLF below. Like the video, help me get the word out, subscribe to my channel. If you like this, comment SLF for me to break down a real senior living facility, underwriting, numbers step by step. Slam Playbook channel, senior living and multifamily playbook. Subscribe, like, tell all your friends. I'm Roberto Carabetta. I own and operate senior living facilities across the Central Florida market.